$2 trillion. That's how much was spent globally in 2017 in just mergers and acquisitions. All sorts of different companies across industries globally, $2 trillion were invested in buying and selling companies around the world. And data shows that over 70% of these deals usually go south, meaning the value is lost for both companies involved within a year. And yet, $2 trillion is being spent a year. And if you look at the last 5 years, they have been record high trades of mergers and acquisitions going on. So why is that? We're going to be covering that and focusing on that. And before we move on, I want to actually thank Ron and Steve for this particular talk. Those of you who are here on a monthly basis, PMI members, we're doing this in collaboration with PMI because number one, we want to raise awareness that some of these failures can be undone if we start embedding things that are usually skills that are part of project and program management. The issue is, what we'll find out, is that many of these people don't know what they don't know. And they don't even consider assigning a leader, a champion, that has the right skills to lead multifunctional teams. And that is the root cause of all these failures that we're talking about. I also want to give a shout out to Podcast Village because partnering with them, we're producing podcasts out of every talk that we're going to be doing this year. And Byond, by the way, Lori, the CEO, is here. And Lori and I have been working on launching a series, educational series, that is all about mergers and acquisitions. And who should care and why should you care if you've been involved in a company that has recently gone through a merger or an acquisition. If you're on Twitter, you can actually use these hashtags to share. You're welcome to take pictures, sharing with your followers. Include those two handles, Byond MA and my own, HM Del Castillo, and you're welcome to tweet and share to any of your followers some of the information and some of the insights that we're going to be sharing in this discussion. The focus of today's discussion, we're going to cover all of these. Number one, why? Why are M&A deals so attractive even though there's so many failures? Number two, we're going to cover a report that just was published earlier this month, by the National Center for Middle Market. And they publish this report once a year because based on surveys of business owners in the middle market and their perception about what just happened last year and what they expect this year to be like. And we're going to summarize all the insights that came out of this particular report. We're also going to talk about root causes for ways to reduce M&A failure, and then 7 steps that we at Byond are recommending to anyone that becomes our client. And even if you don't become our client, at least implement these steps to prevent these type of failures. And lastly, we're going to talk about how do you make M&A deal synergies count? What are they and why do you need to make them count? So the first point is why? Why are M&A deals so attractive? And if you look at the high level, there usually are 2 different ways that any business will grow. Any kind of business, doesn't matter what industry or the type of business you're in. You can either grow organically or you can grow inorganically. Organic growth is really about aligning the people, the processes going on with the product portfolio, and those products are selling into markets, customers around the world or domestic original markets, and that's how you're creating multiple revenue streams from your products. And that can be organic growth. Alignment of your people, your processes, products, and then you're monetizing on that from customers. And organic growth can be great. Inorganic growth, on the other hand, allows you to explore areas that you wouldn't consider because currently your core expertise is not where it needs to be in order to monetize on other things. Even if you remain in the same market, or if you're targeting a different group of customer segments that are not buying from you today, and you're trying to figure out what do you offer to them instead. And when you start creating different concepts about what you could do, you very quickly realize that you have missing expertise and you don't have enough people in your staff and there's too much risk. Well, there's a different way, and that is you can acquire a business that has the right expertise. You can partner with that business. You can create joint ventures. There's all sorts of different ways that you can do, and that really is about inorganic growth. In today's world, you need to do both, not one or the other, but both in order to grow the business effectively, because one or the other is just not enough to get you there. And we're going to talk about that. But here's some of the current companies that in the last 10 years have been forced to merge. A merger is when two different companies, A and B, fuse together, and now they become one company. And usually that one company is rebranded. Dell Computers for a long, long time. EMC Services, IT services, both enterprise users, global companies, they fused about 2 years ago because the markets were going down for both of them. And these are both global companies, multi-billion-dollar companies becoming one. Alcatel-Lucent, if you're in telco, that's another mega merger. That one company based out of France, Paris, the other company that was based out of New Jersey, and now they were forced to merge, fuse together, and their headquarters moved away from US and moved to Paris. Then there's companies that usually will go and just acquire. And you're thinking, wow, these companies are great because they have great products. Well, few people know that many of these great products were never developed inside. All they do is start looking for the right company at the right time to purchase, and they acquire them. And both Apple and Microsoft do this on an ongoing basis. And as a matter of fact, inorganic growth is the main reason why these companies are still relevant today. Meaning that, yes, they do organic growth, but they also focus on inorganic growth at the same time. They do both. Here's an example of the largest acquisitions that Microsoft has done. Skype, Symbian, LinkedIn. Look how much they paid for each one of these companies. Microsoft is one of the companies that typically do this, and they always overpay. Not always the best approach for most of you who don't have the funding that Microsoft does, but it works for them. Apple, all the different acquisitions they've done over time, and by the way, how many of you are Shazam users? You guys use Shazam in your phones? Guess what? They're about to acquire them. They just announced that about a month ago, less than a month ago. And if you look, everything that extends, that becomes a mobile app, that is a favorite app on any mobile device, that's what Apple acquires. And they do this on an ongoing basis because they have teams assigned to just inorganic growth that are separate from the teams that are responsible for organic growth. And then both teams every now and then will come together and say, hey, let's talk. How can we align and realign what we're doing? Because we can't just blindly go without looking at what the other is doing without talking. And they do this on an ongoing basis. The point is, these companies turn mergers and acquisitions and create a competitive advantage because they assign teams, and those teams are responsible for leading work that makes the most sense, that leads to actual positive, massive business growth. And that's what you have to do in today's world to become a market leader and a global company. So between the two, organic versus inorganic, which one is best? How many of you say organic growth is best? Because it's easier to do and you get much higher ROI compared to inorganic. Raise of hands, how many of you say organic is best? It's okay, don't be shy. You can guess. How many of you say inorganic growth is best? It's much easier and is best. Well, guess what? Inorganic growth is best over time. This is not me saying it. This is a Bain report that just came out that looked at decade 2000 to 2010 across industries globally, and they just published a report saying when you compare organic versus inorganic on the average, inorganic is best even though there's so many failure. Why is that? You're saying 70% or more end up in failure, and yet you have a net average gain that is higher than organic growth. Why do you think that is? Can anybody try to guess? How much failure rate is there on organic growth? Even though everybody feels like they're a Steve Jobs or a Bill Gates or the next Elon Musk, what happens to when you're furiously working on just putting out product, and are your customers actually buying the product? Or are you getting new customers to buy your product? Are you getting your current customers to buy the product all over again more often and increase the size of order? All those things are the things that most people fail at, even though they've been doing organic growth for a long, long time. So even though there's a high failure rate in inorganic, there's also a fairly high failure rate in organic growth itself. And so if you're a risk manager within your company and you're trying to figure out which risks should I take and which ones pay off and which ones don't. Higher risk, higher return, inorganic growth, higher risk, higher return. And as long as you get a team assigned and learn from failure, you will get better at choosing what you do and what you don't when it comes to inorganic growth. And vice versa. You can apply the same methods, the same principles to organic growth. The issue is most executives, senior managers, and the leaders within the companies fail to do this the right way across organic or inorganic. And therefore, for the last 20 years, since globalization, the net effect is that globalization tells us that no matter who you are, inorganic growth is easier, gives you higher ROI than organic growth. Hard to believe, especially if you're in a technology company. Believe me, I've been there, done that with people who are CEOs, who are really CTOs, and they say, we got it. We can build whatever we want. We have the team, we can outperform anybody. Problem is, yes, it can build, but building more product, does that lead to more sales? No. That is the answer, and this is why there's so much failure in organic growth. And this, by the way, carries across different types of companies. So here's the flip side. The same report from Bain says 55% of the deals fail because of number one reason, it's they overestimate what they're going to achieve before and after the deal is done. So it's kind of one of these things where you overpromise and underdeliver. And that is the wrong approach. Because what's going to happen to your shareholders when you're promising all these great things, and then a year down the road after the deal is closed, your share point, what happens to your share, to the stock price? Even if you're a private company, your shareholders, the owners, what are they pressuring you for? Because they lost the value. So the bottom line is companies must do both, not one or the other. They have to focus on both when they are focused on growing to the next level. Doing one and becoming great at that and just optimizing, or the other, only gets you so far. Not enough in today's environment across industries to get you to the next level of growth. Market leaders do both of these at the same time, and they assign teams, and they have the teams working together, talking, communicating to each other. How do we create synergies? And how do we maximize the synergies of what we're doing when we're focusing on organic versus inorganic growth? Here's some examples of companies that today are failing. GE. How long have they been around? An American icon, and today they're talking about breaking it up. How did that happen? Remington. Over 100 years around, and they just enter bankruptcy today. Gibson Guitars, the same. And the examples is, number one, GE, they were doing great, and they were doing exactly what I just spoke about, and they were leaders. They became a global company, and then they stopped about 15 years ago because they only focused on organic growth, and they just decided to let go of inorganic growth anymore. And everything started going down and down and down, and right now they're talking about breaking up. And if you track what they've done, we had to bail them out back in the Great Recession days. There were one of the companies besides the automotive industry that we had to bail out, and they're still in trouble today. So let's talk about the report that I spoke about earlier, and that is the state of the middle market. Number one, I want to just understand, what is middle market? Here's a definition. According to the experts, company types can be divided into at least 5 distinct segments. You can have the sole proprietorships. Those are the consulting businesses that have one person, maybe 2 principals. Limited liability partnerships, those are all the sole proprietorships. Usually those are businesses that have less than $1 million a year in revenue. And look at the numbers, 18.3 million of those companies today in US. This includes private and public companies, by the way. Small businesses are the ones that start at 1 million and all the way up to $10 million a year. And today we have slightly under 970,000 of those businesses in US. Then the middle market is divided into 2 segments. The lower middle market starts at 10 million all the way up to 250 million in revenue. And there's about 186, a little bit over more, 186,000 companies that are lower middle market companies. And then there's a middle market, and that are companies that start at 250 million all the way out to $1 billion in revenue. And there's 9,800, a little bit over 9,800 of those companies in US today. And then there's the large companies, right? The ones that we all hear about, Amazon, Google, Microsoft, IBM, have $1 billion or more in revenue, and it's about over 5,100 of those companies in US today. Which one of these are the ones that have been growing in numbers? And which one of these have been shrinking in the last 15 years? Where would you say companies are shrinking on the types? Which of these groups is shrinking, not building up like a scale that goes from one number to another to get to the large companies? Where is there a gap happening right now because of all this disruption going on? What does globalization mean? Well, we're going to talk about what that means, but we're focusing on understanding lower middle market and middle market. That's what this report is all about, that we're talking about here. So number one, this report says, number one, US middle market comprises nearly 200,000 companies, that's lower and middle market segments together, that generate more than $10 trillion. Those 2 segments, the lower middle market and the middle market, all those companies together represent $10 trillion in revenue combined every year. Number 2, these companies are geographically and industry diverse. They go across industries, they are geographically distributed in US, and they are publicly or privately held, both. So it's a very diverse segments, those 2 segments that we're talking about. Number 3, these are the ones that kind of generate the growth within any industrialized country, not just US. Those $10 trillion represents today 3% of all US companies, that's by numbers, account for 1/3 of the nation's GDP. Furthermore, I spoke about that over $2 trillion was spent worldwide. Just above 60%, almost 60% of that was spent in North American companies, US and Canada. 1.4 trillion was invested in middle market companies in North America last year. And this was actually lower than 2016 because it was more investment in that segment, in middle market segments, in 2016. In just middle market, private equity investors invested over $324 billion last year. That's what this report is saying. Here's some additional outcomes. The business owners that were surveyed saying 60% of them believe that M&A, inorganic growth, is vital to grow their companies. That's just what the CEOs of the middle market companies are saying according to the study. And most of them are saying that whenever they look at a deal, when they're about to either acquire or sell a company, they're looking for ROI of at least 26%. The activity of deals, the number and the amounts by year since 2006. And look what's going up. In the Great Recession area, 2007, it peaked, then it dropped for a couple of years, and now it's coming back up. There was a little bit of a correction in 2013, and it's been going up. And even in the current administration, it didn't dramatically decline. It actually just slowed down a little bit. But it's at an all-time high. If you look at historically, we're at an all-time high in M&A activity, which means what? If there's a lot of disruption going on, most everyone says, forget organic or continue to invest in organic, but also look for inorganic growth opportunities. So what that means is that if you're a middle market company and you're not doing this today, don't feel alone, because that's about 40% of those companies that just don't want to do it for whatever reason. Guess what's going to happen to the 40% of those 200,000 companies that we're talking about when those 40% are not even thinking about or preparing for M&A deals? Where are those companies going to be 5, 10 years from now? Well, I can tell you, many of them are either going to go out of business or they're going to go on a fire sale, just because they're going to have to sell themselves at some point. Here's the reasons why companies the CEOs are saying why we're selling or why we're buying. The buyers are saying it's because it's a strategic decision for us. We want to grow into something different. Or we always look for opportunities and we find them. We know that it's only a time window. We moved them this year because we couldn't wait. Or the opportunity presented itself as they were networking with people. The sellers, two main reasons. One is, hey, we got an unsolicited offer and we just took it. Start looking. And the other ones decided that they were going to start looking for a suitable buyer. Here's what's happening to multiples. I mentioned that right now, that middle market segment has been shrinking over time for the last 15 years or so. It is a seller's market across industries. Look at the multiples that people are paying for these companies. It's going up, and they've been going up since 2012. And it's probably going to continue going up just because very few are selling, and it's a seller's market right now. So the moral of the story is that if you're looking to buy now and you didn't before, you missed out, because now you're going to have to basically pay what the sellers are looking to get paid. Yes?
Are you seeing any differences in multiples on accretive versus strategic type acquisitions?
So there is some differences, but right now, for the most part, it's a seller's market all the way across. The question is between strategic deals versus financial deals. And anyone that is doing this, there's at least two different types of buyers in any M&A transaction. Strategic do it because they want to forge ahead and move in a different direction, or it accelerates getting to where they want to be as a business. Financial buyers are basically looking for opportunities of companies that are just for sale because they're in need. It's either death, divorce, or retirement of the owners, or phasing out a current owner and bringing somebody else instead, and the other ones stay. These are all different reasons why the financial sellers that don't prepare themselves just find themselves unprepared. And financial buyers are always looking for those opportunities. So some of the reasons what they cited, what they're moving, it's information that's also part of this report. I want to move on to the next phase, which is saying, why is it so complex? And the number one is that much of the expertise, these are not the people that you have as your workers. Because typically, whether it's an advisor or a law firm or an accounting firm, that also the top 3 resources that any buyer or seller, according to this report, go to, they all are people that have decades of experience in specific industries, and they can help guide decisions made by the owners of the company. And yes, there are others people that provide the funding, the financing piece, private equity investors included, corporate banks, tax advisors. And any of these transactions are part of capital gains tax, so many people have to do planning, and the more planning you do, the better it is in your favor for if you're the owner, because it's all about avoiding capital tax gains. And you can actually structure the deal that way if you're smart, if you're prepared. Most people don't, and they just want to get paid, and then they have to pay half of their transaction to the government just because they don't plan adequately in the way that they get paid. So a steady deal rhythm of transactions is what they are saying, but most of the business owners who try to do it on their own fail because they do not have the right expertise, either themselves nor their staff, nor do they even consider finding a qualified advisor that can help them along the way. And that's the majority of the failures. That you have a lot of unknown unknowns that you don't know, no one in your building or that you work for or that you know knows how to deal with them. And you don't even consider going to an outside advisor for help. And the industries, those deals, how they're broken down into industries, there are top 3 industries that are right now maximizing their valuations. Anyone that is a healthcare company, anyone that is an IT company, including software, and then materials and resources. And it is expected that those are going to remain the top 3 types of companies. So if you're in healthcare, if you're in IT, if you're in materials and resources or logistics type of company, that if you're in that business, it's a great time to consider figuring out when that you want to exit, because right now you can exit and get rich really well without necessarily stopping the work that you're doing, because you can proceed and do other things when you plan adequately. Financial valuations and post-merger integration is what complicates the deals. And this is where most people don't know what they don't know. There's a lot of complexity, a lot of ambiguity, and a lot of uncertainty. And you need the expertise because you need people who are great at managing risk. Assessing, estimating, managing risk. Which profession does that best when they're trying to do so? Who's a risk manager? Who's doing risk management right now in your roles?
Cybersecurity.
Yes. When you're managing a project that is a large investment from the company's point of view, aren't you managing risk? This is risk at the company level. Not just project or programs, it's the entire business. And somebody needs to find out, how do you diversify investments across organic growth and inorganic growth and create the synergies? No different than managing a specific project that is part of organic growth or projects that are part of inorganic growth. Project management, risk management are critical factors that most people don't even know where to start when you haven't done this before. But it is something that you can teach, you can learn, if you set your minds to it. Most deals take less than a year to close, that's what this is saying, but becoming deal ready, whether you're a buyer or a seller, takes years. Usually takes about 3 to 5 times longer to get ready to become deal ready, whether you're going to be buying or selling, than it is to actually do the transaction, because the transaction, on the average, it's about a year, give or take. But I can tell you, when you come in unprepared, which most people do, because they haven't done this before and they're thinking, hey, I got this, I can do this, I'm a rocket scientist, I can do this. Guess what the answer is according to the numbers? Question?
Yeah, what does it take about a year? What is the average transaction size? If transactions are smaller, is the time frame still the same as the time frame?
The time frame, that's a great question. So the time frame does not vary whether you're a small business all the way up to a large company, pretty much remains the same. The larger you are, yeah, you can actually extend a little bit longer, but usually most deals don't take longer. There are some, let's say, like the Alcatel-Lucent merger, right? That require governments to say, yes, go ahead. Not just our government, but also European Union and France. And sometimes when you're a larger corporation, yes, it takes longer, but middle market companies, for the most part, they're pretty quick. But sometimes if you're in a heavily regulated industry, like healthcare, for example, if you're a medical devices company, for example, yes, there may be some slowdown because of regulatory compliance issues, and somebody needs to okay the sale of the company, that is, the government needs to okay it. That's the only thing that can change that. So keep this in mind. It takes more to prepare to be deal ready, whether or you're going to be a buyer or a seller, than it actually takes to actually do the deal. So the key takeaways from this report are 3. Number 1, middle market CEO know that M&A, it's critical to grow their business. No longer are they saying maybe. They're saying we need inorganic growth in order for us to get to the next level of growth, not just organic growth. And while most people recognize it, most executives that don't have any experience often are surprised by the complexity of the transaction. The moral of the story is the more prepared you are, if you have a business, the more prepared your staff is, and create the right environment, the right team, you can actually make this work to your advantage. But it requires business transformation to be able to do that. Let's talk about at a systems level thinking. Why reducing M&A failure is important. How many of you have a retirement plan no matter where you work? 401k or some sort of IRA or something. Who's controlling? Are you guys personally managing the funds that you're investing in for the future, your retirement, what they're investing in? No, right? We just say fund A, B, C, we scatter across 5 or 6. Some are growth, some are more conservative, some are bonds. It's going to be diversified, right? And we just let the fund managers take care of that. What do you think the fund managers are doing with their money? They're actually playing in here, betting. How well do you feel about playing roulette, Russian roulette, with your retirement money? This is the reason why you need to understand this, because you need to figure out how to help your company if you're at that senior level where you can actually tell your business owners, let's find the right people and let's start looking, because it's going to take us a few years to get prepared to be deal ready. It's inevitable, no matter what type of company you are today. This is what the future is in the next 10 to 15 years. Number 1, reason you prevent long-term reputation damage to your company. If you're doing it wrong, it ends up being long-term reputation damage. Your shares go down, your revenue goes down, and then your growth outlooks go down. It's a spiral that you cannot stop. You avoid substantial customer loss. What happens when you lose too many customers, and how long will it take you to recapture or gain new customers to replace the customers you just lost? Where is BlackBerry now? And where were they 7 years ago? And yeah, they're trying to come back because they're saying they're coming back, but no. It was a company that was they were a large corporation, put all their money into organic growth, one product, lost its unique value proposition. Apple and Samsung gained, they lost.
Research in Motion.
Yeah, Research in Motion, they've renamed themselves before they went out of business, called BlackBerry. But it was formerly Research in Motion, then BlackBerry, and then bankruptcy, or shrunk. Eliminate decline in unique value proposition. That's what you need to do. And just working on organic growth is not going to do much at all but maintaining your unique value, especially when you're in a crowded market and everybody is saying, me too, me too, me too. What happens to your customers when everybody's saying, me too, me too, me too? Are they going back and buying from you, or are they buying from somebody else who's much better at marketing than you do because you're focusing on technology? Avoid giving advantage to your competitors. What happens when you lose the value? What happens to your employees? Do they stay? And are the ones that leave first the ones that you want, that you can let go of? Or is it your stars, your key staff leaving? Worse, they leave and then go work for your competitor. Avoid negative growth outlook. Once the growth outlook looks flat or down, what happens to the environment itself? What happens to employee morale? Avoid massive financial and non-financial losses. Non-financial losses are the perks. You have a great work environment and all of a sudden you have to cost reduce, and then you start now forcing people to come in every day to some far out office space when it used to be that three to 5 times a week, 3 times a week you could work from home. What happens to people and employees and the morale? Avoid considerable job loss. In some markets, an entire industry, and because they bet the entire state economy on one industry, and that industry tanks, like oil and gas, like the coal industry. Look at what's happened to West Virginia. They put all their bets as a state into one industry that has now in decline, and now massive job loss. And people are going to have to move away. What happens to their tax revenue when workers are not working, and worse off, they actually move out of the state? Not a good situation for that state for a long time. And some of these employers, I mean, think about Remington. Think about where GE has major presence. Think about where Gibson has a major presence. And even other companies that are going right, like Xerox. What is happening to those cities that don't have the diversity in industry, that when somebody's going down, they have job loss, massive job loss, and the economy, local economy, goes down for some time before it's able to recover? 7 reasons why. Here's the 7 steps to prevent some of this failure. And this is all based on applying systems thinking to the M&A process. How can you avoid, eliminate risk that are your top risk factors based on what we just discussed? Number 1, executives, owners need to set a compelling vision about where the company is today and where it's going in the next 5 to 10 years. And realize that a component to realize that strategy, you need to diversify investments across both organic and inorganic growth. No choice. Figure out how to do it. Here's an example. Apple and Corning. Just earlier this year, Apple announced that they were going to invest $1 billion back into US companies that they partner with to bring back manufacturing work to US for across Apple products. Any smartphone, any tablet, any mobile device that Apple sells today worldwide uses one glass that was originally produced by one US company, and that is Corning. Gorilla Glass is their glass, and it was originally developed in partnership with Apple for every mobile device that Apple sells. And Corning has done great because not only are they selling Gorilla Glass to Apple, they're also selling it to Samsung. One company grew, the other grew, both US companies, economies, and jobs grow. Out of that $1 billion, just this week, Apple announced they're going to invest $200 million back into research and development for Corning to actually develop the next generation of Gorilla Glass. And Apple has done this great that now the speculation is, hey, if Tesla goes in trouble because they're not able to deliver their current low-cost model, guess what's going to happen? Apple is not an automaker today, but pretty easily they can buy shares, majority shares, into Tesla. Where is Apple's headquarters located? Where is Tesla headquarters located? Don't they know each other? Yes. Is it possible? If people are talking about it, I can tell you there's already venture capital firms and private equity investors saying, we want to help you. We want to help you. How much do you need?
Menlo Park, California.
Sorry?
Menlo Park, California.
That's correct. They're all right there in the same 5-mile radius called Silicon Valley.
They're all right there. Right next to Stanford University.
That's right. Number 2, assign a champion. If you're not prepared to do it as a business owner, find somebody who's going to be an insider who can help you. And that can be a a director, or another of your co-owners that leads the effort of inorganic growth. Just like the CTO or CIO are responsible for organic growth, you should have some chief executive officer, owner of the company, even partial owner of the company, leading the effort. So would there be a chief M&A officer? Well, there isn't today, but I would consider figuring out what title do you give that person. Some companies are creating their own titles called Chief Digital Officer, because digital transformation is not just about organic growth, it's also about inorganic, finding the right companies to acquire to add value and digitize your business much faster and creating that synergy. Here's an example, Amazon with Amazon Web Services. Not only is Amazon Web Services a market leader because they have the majority of the market share around the world in cloud services, and everybody else is a distant second. All the top 5 are a distant second to Amazon Web Services. But Amazon Web Services has been using any business who's a digital business to begin with, that is already leasing AWS infrastructure to do what? As soon as they get in good enough to say, hey, we have a viable business model, what do? They acquire them, like Zappos. And they do this ongoing. They basically survey every single AWS user that is growing, and before they get too big too quickly, if they know there's a market, they will just acquire them and integrate them onto Amazon. Growth through acquisition is Amazon's way of growing the business. And today, they're the e-commerce global leader, second only to Alibaba, who's doing exactly the same thing, but in China. Amazon also just last year announced they acquire Whole Foods. Does anybody know how much they paid for Whole Foods? It's way too much. It was almost $17 billion. And yes, if you guys are Whole Food shoppers and you're still there, they're now owned by Amazon. And they're going to continue because Amazon also has been expanding and actually has been outpacing, the growth of Amazon has been outpacing the growth of every single company. And Apple is number 1 today, number 1 global company based on brand. But Amazon is outgrowing Apple today. They're outgrowing everybody else. Just last year, Jeff Bezos became the richest billionaire in the world. Amazon is on a growth pace, and because they've been doing both organic and inorganic growth for a long, long time. Cisco and Alcatel. The story of one company that used M&A to disrupt an incumbent. Bottom line is, Lucent's share value lost. They had to merge with Alcatel. Cisco has been doing this inorganic growth through acquisition for a long, long time across all sorts of software sectors. Software and computing hardware, networking equipment. Number 4, enhance your value proposition. This is what Verizon has been doing when they acquired Yahoo, as well as America Online, which is now called Oath. Another company that went from a phone company, a wireless phone company, to a media company, and now they own lots of different media that is the newer digital companies. Number 5, evolve your business model. Evolving your business model means you always are looking for the right acquisition. And by the way, the next 3 examples are local companies that were originally born and raised in the DMV area and now have been acquired by one of these other companies that usually are looking for the right business to acquire because they're growing. SourceFire, how many of you are familiar with SourceFire? Cybersecurity company, born and raised out of Columbia, Maryland, grew to about 3,000 employees by the same founder. Last year, he exited, sold to Cisco for just under $3 billion. And all they do is commercial cyber work, no government. Commercial cyber work is outpacing federal consumption of cybersecurity. Number 6, always seek new ways to make synergies. Micros, another company that was born and raised in Columbia, Maryland, point of sale solutions to restaurants, food service around the world, a global leader, mid-market company that was bought by Oracle last year, or maybe 18 months ago, I want to say, also for a few billions of dollars. And they still have a presence here, but what do you think happens to the jobs for SourceFire and Micros 1 year, 2 years post-acquisition? Where do those jobs end up moving, especially when they're senior management positions or executive positions? Where are Oracle and Cisco headquartered? Yep. Job loss, gradual job loss, and we're not replacing those jobs as these acquisitions happen when they're coming in from outside. Integrate quickly and responsibly. Once you start post-deal, integration is key because that's how you make your synergies count. Here's an example. Discovery Communications, headquartered out of Silver Spring, Maryland for the last few years, announced last year they were moving their headquarters to New York and just announced recently that they are acquired Scripps. Scripps does all the HGTV, Food Network. They have about 5 or 6 different channels that are all on cable. They actually are the owners of those channels, and Discovery is about to acquire them. Media company acquiring other media companies.
By the way, all the technology jobs are going down to Knoxville.
That's correct. Job loss has been around. Discovery used to be much bigger 3 years ago. What do you think is the job losses in Silver Spring since 3 years ago when they already were about to acquire, because they prepare, remember it's about 3 years to prepare to buy a company. They already knew they were about to buy this. They didn't announce it until the deal is done. So they knew they were already doing this and they had to fundraise. So where do they get their money if they're moving to New York? Who's financing them? I don't know, some hedge fund from Wall Street, maybe, I'm thinking. Private equity investors, and now they're moving to New York. One building in New York City. How can you justify the cost of living of being in the middle of Manhattan to Silver Spring, Maryland? I don't know, but all I know is that we've lost about 1,500 jobs, Discovery jobs, since 3 years ago, when they were already working on this deal. Making deal synergies count. Number 1, Bain is saying you got to do 3 things right that are root cause. Number 1, there's a very tight window of opportunity. If you don't move, if you're not nimble enough, you lose it, it goes away, and it doesn't come back anytime soon. Now you have to work harder for your next deal if you miss the opportunity. Number 2, if you fail to push beyond the benefits of just the initial synergies, that's the wrong direction. You need to continue to always look for additional synergies. It's key. And often, getting involved in the details, you lose your sight as to where you're going or what you intended to achieve in the first place. Do not let this happen. You need to have leadership, the right leadership in place to lead your inorganic growth initiatives. So therefore, the companies that acquire the synergies and actually deliver what they promised before and after the deal get rewarded by the shareholders. This is what McKinsey is saying off of a study that just was published. Key takeaways are all here. Number 1, M&A is critical for growth. No choice, you have to figure out how to do it if you're not doing it today, especially if you're a middle market company. Number 2, build the right team of experts. If you haven't done it before or it's been a while since you did it, I guarantee you, you do not have the right experts because everybody is focused too much on organic growth. Find the right experts to help you. Understand what it takes to be deal ready. Most people don't even know what it means. And therefore, they don't even start until it's too late. And they come to us saying, hey, we want to sell or we want to buy 6 months from now. And we're saying, wait a minute, time out. Number 4, get your employees and collaborators on board. Your supply chain, your partners, your distribution channels all need to be aligned and at least agree, because they will help you. Number 5, build shareholder and investor confidence. That means you have integrity, you are trustworthy, and you walk the talk. Number 6, make synergies count and maximize your synergies. Number 7, look for more synergies even before and after the deal, because it's key. It is that important. We're going to wrap up real quick. And I want to say, I know that I'm actually running a little bit late, so I want to close off and say there's more information. We have an upcoming talk at the Silver Spring chapter in next month. It's an evening event. We're going to talk about digital deals and what that means. The next one is also for business owners. We're going to have an exclusive event for business owners of middle market companies and have a panel discussion of experts to talk about everything you ever wanted to know about M&A, but were afraid to ask.